Welcome to our lecture on international financial management, focusing today on the crucial concept of liquidity. Let's begin. Liquidity refers to how easily a security can be bought or sold in financial markets without significantly changing its price. Highly liquid securities can be traded quickly in large quantities and with minimal price impact. Conversely, illiquid securities are harder to trade and often involve higher transaction costs. Next, let's explore how order costs influence liquidity. Order costs are expenses incurred when executing trades, such as brokerage fees, bid-ask spreads, and taxes. Higher order costs discourage frequent trading, which in turn reduces overall market liquidity. Conversely, lower order costs encourage greater market participation, thereby increasing liquidity. For example, a wide bid-ask spread makes it costly for investors to enter and exit a position, significantly reducing market liquidity. This deters potential traders. Now let's consider inventory costs and their impact on liquidity. Inventory costs arise because market makers hold securities in their portfolios to facilitate trading, exposing them to price risk. Higher inventory costs, often due to increased risk or capital requirements, reduce a market maker's willingness to provide liquidity. This leads to wider spreads. Conversely, lower inventory costs allow market makers to quote tighter spreads, which directly increases market liquidity. This makes trading more efficient. For instance, when interest rates rise, the cost of holding inventory becomes more expensive for market makers, leading to reduced liquidity provision and wider quote spreads. Trading volume is another critical factor closely linked to liquidity. Higher trading volume means there are more active buyers and sellers in the market. This increased activity reduces transaction costs and significantly increases market depth, making it easier to execute large trades without impacting prices. This enhances liquidity. Conversely, low trading volume indicates fewer market participants, making it harder to execute large trades without affecting prices. This reduces overall market liquidity. Competition among market makers and traders directly impacts liquidity. More competition generally leads to narrower spreads and more efficient markets. This increased efficiency improves overall market liquidity. When competition is limited, it can lead to monopolistic behavior, resulting in wider spreads and reduced liquidity. Electronic trading platforms, for instance, increase competition by allowing multiple market participants to provide quotes simultaneously, fostering a more liquid environment. Finally, volatility affects liquidity in complex ways. High volatility increases uncertainty, causing market makers to widen spreads, which reduces liquidity. Conversely, stable markets encourage tighter spreads and greater liquidity provision as market makers face less risk. This creates a more predictable trading environment. During financial crises, volatility spikes often coincide with a sharp drop in liquidity, a phenomenon known as shaved liquidity. This makes it extremely difficult to trade. In conclusion, liquidity is essential for efficient and stable financial markets. It is influenced by a combination of factors including order costs, inventory costs, trading volume, competition, and volatility. Understanding these factors is critical for participants in international financial markets, as liquidity directly impacts pricing, transaction costs, and overall market stability. Thank you for watching our lecture on international financial management focusing on liquidity. See you at the next lecture.